live virtual classes for the paper Advanced Financial Management. That is paper number 2 of the final level. ICAI Ashish Gupta, Joint Director, Board of Studies, Board of Studies welcomes you all. Now, student, first of all, Rohan, good morning. And the Ravinder is also there. So, student, now when we talk about this topic of security analysis, now we can say that it is the beginning of the new topic, or we can say that it is the beginning of the new section, because in the earlier last class we have completed the first section. Now another section we have started, and basically if I tell you, it covers three topics. One is security analysis, security valuation, and portfolio management. Overall, these three chapters consist of a subject that is called security analysis and portfolio management. So basically, in fact, in an MBA, these are the three chapters covers the overall subject there. That's why our coverage of course, we have an in-depth analysis of the portfolio management, all the various aspects of the portfolio management. Even in security evaluation, we will go into the deep dive. But so far as the topic of security analysis is concerned, its coverage is quite limited in our syllabus because security analysis topic is very wide. Okay, it says if it can run into many number of pages, but due to seeing the we can say that overall weightage in this paper, we are doing we are trying to cover important aspect of the security analysis. Now, when we talk about the security analysis, basically we shall cover this topic of the security analysis in two parts. So today we are starting with the security analysis part 1. Of course, if time will permit, we can move on this part 2. Our security analysis part 1 is mainly concerned with the fundamental analysis. Okay, then part 2, we shall cover technical analysis, and efficient market hypothesis. So overall, this topic has been covered in the three topics, that is fundamental analysis, technical analysis, and efficient market hypothesis. So in today's class, we shall start with the fundamental analysis, and of course, assignment has been uploaded there, and I think you must have received this, you have downloaded the same. So today we will attempt the first question of our assignment as well. Basically, it is relating to the fundamental analysis. Now, when we talk about this security analysis topic, now initially, whenever we talk about security analysis and portfolio management, so why this we carry out security analysis? It is important to understand. We carry out the security analysis because ultimately, if we see that why we do it, because we want to invest the money. We have the money, we want to invest it. For so far the securities are concerned, securities can be of many types, like equity shares, preference shares, debentures, bonds. So these are some financial securities, because please always remember we are here discussing with the financial securities. So whenever we start with the investing in any securities, we are looking for investing in some securities. So first part comes what is our risk appetite, or we can say our risk profile. Student, please always remember that risk-free securities are there are two type of securities. One are risk-free, another is risk securities. Now, when we talk about equity shares, now if we say that what are the risk-free securities, generally treasury bill. These are risk-free securities. Why treasury bills? Means the bonds issued by the government. Generally, they don't carry any risk. Okay, they are generally paid, their interest is paid back, and their repayment is also paid back because they are sponsored by or they are guaranteed by government, respective governments. In India, we can say that post office schemes, all these schemes are there. So post office and even RBI comes out with the government bonds, treasury bonds. And for in the USA, it is called treasury bond. In government, it is called in India, it is called Government of India, state government bonds. central government and state government bonds. Generally, these bonds are used by provident fund, pension funds, or etc. because to ensure that they want to have some fixed amount of money. So generally, the interest inflow, these are income are in the flow of interest. So these are generally safe and fixed. Even you must have noticed that the pensioners generally they prefer to invest the money in the fixed deposits. Okay, in there because fixed deposits generally carry lesser risk. So they say we don't want to go for the equity. So they say that we want to have a less risk. Okay, because equity carries more risk. Similarly, uh, this is preference share also have some generally don't have any risk because they have a fixed dividend. But the beauty of investment in equity is that more the risk, more the expected return. Okay, and what are the forms of their expected return? Generally, if I did not to tell you, it is generally in the form of dividend and capital appreciation. State government, yes, Sai Kumar, you are right. State government securities does not have same rating as the central government rating. But see, beta, there is a something. It is a very you have asked a very raised a very good question. Now, what happens? Rating and yield have a opposite relationship. Now, the companies have a good rating, or the government, the bond have a good rating. They have a low yield. Generally, they offer lesser rate of interest. Okay, that's why I think you must have heard the term name junk bond. Junk bonds are those bonds. These bonds are very, we can say, likely to be defaulted in the repayment, but they are very cheaply available and their interest income is very high. Okay, so that's why we have to take care. On the other hand, higher the rating, higher the surety that our money will be returned, lesser will be the our return. So that's why there we have to make a risk return trade-off. And ultimately, when we talk about this is the target risk return profile, it depends on the risk appetite of an investor. In investor, there are two type of investors. Say in your age, you may have a high risk appetite. Okay, because you have a time to come. You have a time to come, and because you, if any loss will be happen, you will recover the same. But a person in my age who has crossed the 50 does not have the same risk appetite because after some time I will get retired. So I don't want to invest my money because if the money is lost, then my pension life will, our post retirement life will be quite tough for me. So that's why I may have a plan to invest the money in the safe securities that so that my post retirement period go through very well. So this is the thing. So whenever we talk about equity share, so equity shares generally have a two type of income, and I need not to tell you because if you have gone through your financial management paper and there the topic of cost of capital, we have a one formula. Okay, KE is equal to D1 upon P plus G, if you remember that. Okay, so here our sole criteria was basically dividend. Of course, capital appreciation is one of the important factor. Okay, because generally capital appreciation is generally considered for the secondary market point of view. Whereas this cost of capital is generally considered from the equity point of view, company's point of view. So whenever we talk about any security, we have to see what is our expected return. And when we have a risk appetite, so of course we shall match according to the same. You can see the diagram. Okay, now here maybe it is a low risk, but return is also low. Okay, so it depends, but generally what happens that will be more covered in a high, we can say that it is a more detailed topic. Discussion will be more detailed when we shall discuss the topic of portfolio management. There we shall discuss one topic, Markowitz frontier. Okay, so there you will understand what is the risk profile and how it is matches with the expected return. Okay, but here just I'm sure, want to discuss with you. It is basically the choice of the security depends upon the target risk return profile, or we can say it is some kind of a trade-off between risk and return. What is the trade-off? It is very simple logic. Same risk in a two securities, then we shall go the security with high return. Okay, if two securities have a same return, same risk, then we shall go for a same return, then we shall go for a security that has a low risk. So this kind of a risk return trade-off we have to establish for making our choice. So this is the starting of any security analysis. Now, when we talk about this methodologies for the evaluation of securities, it is important to understand that broadly there are two types of analysis. One is the fundamental analysis. Okay, another is technical analysis. Okay, fundamental analysis basically concerned with the risk return characteristic of the securities. Here we measure what are the risks involved in the securities and what are the expected return is there. So accordingly we meet our requirement. That is that we have done here in the previous slide. We go by this principle. Okay, and we have to analyze these factors. We carry out an in-depth analysis for these factors. On the other hand, technical analysis is go by the demand and supply of the securities. Okay, they don't bother in the technical analysis. What we see, we don't expect what is the expected return or return risk is there, but it basically demands on demand and supply, and that is basically capital market dependent. These are the this is determined by capital market. Okay, it is by the see in the equity market there is a secondary market. Okay, of course for the debenture there is a secondary market, but that has not been developed in India that much. Okay, generally in for the debentures or the bonds, there is a secondary market, but generally these market is we can say that dominated by the banks, pension fund institutes, or investment bankers, or basically banks, we can say that, where they do the sale and purchase of these bonds for in the high denominations or high value transactions are there. Of course, government of India has come out with the retail participation in the bond market is as well, but it is still now it is in a nascent stage. So it is expected that after some time it may develop, but right now it is not that much developed. So what we see, basically it is a demand and supply of the position that is determined by the capital market, share market, stock market. Okay, there if any share is in a more demand, of course the supplies are limited there. Okay, why supply is limited? Please remember that whenever companies come out with an issue, if you see the balance sheet, okay, they are the authorized capital, then subscribed capital, sorry, then it is the issued capital. Okay, so these number of shares is limited. Okay, these shares, there is a number of is limited. If any person want to invest the share, so the company will not issue the new share. Ultimately, he will have to move to the secondary market to acquire these shares. So that's why this is a secondary market where the demand and supply determines. Supply is a limited. This much number of the, and what are the, see, there are one thing more as well. Whenever we talk about the share capital, there are two type of share capital. Either free float market capital is there. The free float capitalization means, or we can say free float capital means a part of the shares may be retained by the promoters, okay, and one part may be retained by the institutional investor or lenders. The other part is held by the other investors. So generally the other part of investors are generally floated in the market through the secondary market sale or the sale and purchase. So there the demand is a fix. Okay, when the supply is a fix. When the supply is a fix, but the demand can vary. So it depends upon the demand and supply variant that determines the prices. So that part covered by the technical analysis. Then there is a methodology so far as the uh, or derivative market. That's in Sai, your question that supply for the share, of course, supply for the share is limited. But so far as the derivative is concerned, if there is any regulatory requirement by SEBI, then of course, because sometimes there are some requirements by the SEBI that much. See, there is always a proportion need to be maintained between the cash market and derivative market. Okay, you are talking about derivative, that type of question. The topic of derivative will be discussed later on. So I think if we don't move, because if we move to the derivative discussion, it is an ending discussion at this moment of time. But derivative market, of course, is determined by the underlying asset. So their value, their supply cannot be, can say, limited. But of course, there if restrictions are placed. Supply comparison, see, supply is in a derivative market is cannot be say that it is limited. It depends on the there is one concept of open interest. I don't want to go into nitty-gritties right now. There is a concept of open interest where the number of contract purchase and sold are basically there. But generally, of course, their supply is limited in the sense that if the options are in the money, out the money, add the money, then these are some technical terms. So according to this, they determine the fact. They are determining factor. Okay, right now we are not going to the derivatives because it will be deviate from ourselves from this discussion. Now, when we talk about the methodology, quantity restricted on, I cannot right now because it is somewhere determined by the exchange. I think I am not playing in the market very frankly, but generally if we talk about I think index, for the index there is a restriction, and for the other I have to check. Okay, but I think there is some proportion is maintained, need to be maintained. Then there is a methodology evaluate foundational, economic, and the business drivers. Okay, how we evaluate, use the fundamental. Basically, we evaluate the economic analysis and business drivers. Business drivers are generally industry analysis and company analysis. So basically, we can say that in methodology of the fundamental analysis, three type of analysis are involved: economic analysis, industry analysis, and company analysis. On the other hand, when we talk about this methodology of the technical analysis, it is share prices trend and the market momentum. Now, what is the share price trend? So see, if we see that, we of course in the next class we shall discuss in detail. The share price move to be like in move this in direction. Okay. Now, according to the technical analysis, we always promote that, or they target that we should enter into the market at this moment, okay, when the prices are lower, and we should exit the market at this moment so that we can make the profit. Okay, this is the entry point, and this is the exit point. So determination of entry or exit point is mainly determined by the price trend. So they go for in the technical analysis, we move for how we can, where at what time we have to enter into the market and what time we have to exit the market. This is the main criteria. Okay. So I think it is a slight discussion. Of course, we shall discuss in the detail. Now, when we talk about the anchors of the intrinsic values, okay, what are the anchors of the intrinsic value? The fundamental analysis is based on the assumption that the share price depend upon the future dividend. Basically, this is the model. Okay, basically this is the model, and in plus we can say that it is the expected price. end of investment period is also these are the criteria. So generally we can say that, of course, in the most of the questions you will see that our expected dividend. See, so far as the prices is concerned, we generally consider that we being a conservative look, we generally don't estimate the price, or we don't expect the price to rise that much, because it depends upon the ultimately it depends on the demand and supply in the market. Of course, one thing is certain, in a fundamental analysis what we see, one thing is certain, that is the dividend. Okay, so future stream of dividend is one of the important criteria in fundamental analysis. They say that, of course, see, I tell you one thing, technical analysis, or we can say that market forces determine the demand and supply. We can say that it is somewhat kind of a behavioral aspect as well there. Okay, they're always not guided by, or we can say that they are not always motivated by only the fundamental factors or the risk return profile. They are generally behavioral aspect is there in the technical analysis. Say, I just tell you one thing. It is sometimes seen that a demand of any particular product in the market may be rise due to some spread of the news. Okay, sometime it's some. I remember that sometime in a time of COVID, I think it was the news spread like that. If we consume the medicine of paracetamol, then the chances of catching the COVID is becoming is a lesser. So all of a sudden, from the market, all the paracetamols have vanished. Okay, all the customers start buying that paracetamol as a precaution, and they start consuming. So basically, these things are determined by the behavior. Okay, but if we see the fundamental, that whether there is any study, or whether there is any research paper, or whether any role, or we can say that in-depth research, laboratory research, that whether this paracetamol have the impact, there was nothing like that. So similarly, in case of a securities, we are generally expect, or we generally go for the stream of dividend. We bank upon the stream of dividend that is likely to we receive in the future as a criteria for the fundamental analysis. So what we do, we compute their present value analysis. Of course, when we shall discuss the topic of security valuation, then this aspect will be more clear to you. Now, these are the two engines for the price estimation. Of course, dividend is there, but apart from the dividend, there is one factor is dividend growth. Dividend growth model is also the price engines for the price estimation, because dividend generally grows with the growth of the profit of the company. So you have seen that there are two type of formula when you were saying, and we were discussing the topic of capital, cost of capital in your intermediate level. The dividend is fixed, so we compute KE is equal to D0, because D will always remain the same. It will be like this, P0. Okay, when no dividend was declared. On the other hand, if the growth factor is, then it goes like this, D1 upon my P0. Okay, plus G. So D1 is means basically expected dividend. Okay, and which is equal to D0 into 1 plus growth. And there is another is PE multiple model. Now PE multiple model, yeah, it is a Gordon model. Ravinder, you are right, better. It is a Gordon model. But see, as I told you in my first class, when you were discussing the topic of cost of capital at your intermediate level, your purpose was to, this was missing figure. Okay, this was missing figure there. This was given to you, this was given to you. Okay, this was given to you, this was given to you, this was given to you. But now when we shall discuss at this level of final level AFM paper, this will be given to you, or this will be computed using the CAPM model that we will discuss later on. This will be figure given to you, but you will be given this. You have to calculate this figure. This will is the expected price. Even this figure will be given to you. So accordingly, this interchanging of equation lead to, यार उसका वॉल्यूम सुबह करवा देना बाहर वाले का, थोड़ा सा आवाज अंदर. Okay, so this formula becomes like this. So this figure is available with you, this available with you, and this is the expected. So ultimately, it's a Gordon model. Only the variation of the Gordon model is used to compute the value of the securities. And even instead of dividend, we can also use the earning per share as well. Okay, then there is a PE model, price earning ratio model, PE model, price earning multiple model. There are other varieties are there. Of course, we shall discuss them later on. So generally, this is a price. How it is? What is exactly this is price earning models? Price earning ratio means market price per share divided by EPS. Okay, of course, this MPS is determined by the market. Okay, and what happens? Sometime any industry may carrying some PE ratio. Okay, some industry may carrying some PE ratio. What is industry? Of course, the industry analysis is there, but I don't need to explain you. Industry basically means where a group of companies of producing or providing services of the similar category, okay, they are considered as an industry. So sometimes say what happens, any industry may having some we can say that price earning fixed ratio, or somewhat say I say that suppose I say that hotel industry is carrying a PE ratio of 5. Okay, so hotel industry carrying a if equity ratio price earning ratio of 5 means if any hotel, say X Hotel Limited, having earning per share of say 12 rupees. Okay, so if the PE ratio of the industry is 5, so the justified price is somewhat like 12 into 5. Other hotels say, while Hotels Limited, they are having a PE ratio of say 20. Of course, their EPS is, sorry, EPS ratio, EPS, their EPS is 20. So their 20, if multiply with the 5, so we can get the value of 100. Okay, so we can say that of course the PE ratio is almost near same, but because of difference in earning per share, the shares of this company Y Hotels Limited is more. Sai, beta, you are asking, you are putting up the question that are we shall discuss whenever we discuss a topic of security valuation. Right now, I am not discussing undervalued or overvalued. That we will take later on. Okay. Now, another version of lenses of the security analysis, we can say that if we say that one is intrinsic lens, another is behavioral lens that I have made you understood. Now there is another aspect, efficiency lens. Okay, these are the three lenses from which we can view the technical analysis. When we talk, security analysis, first is fundamental analysis. I need not to tell you, but we have to deep dive into the intrinsic value. Intrinsic value means it is the justified values. Okay, fundamental value. Okay, it is also called fundamental value because it is computed on the basis of the dividend expected. Okay, very frankly say I give you a very small example. Say if you are I just say that if you're say buying a house, new house, okay, so the say the new buying cost is 50 lakh rupees. a small house, say you have once you become a chartered accountant and you buy a house, okay, and you are, because some you have saved some money and you are planning that I make some for investment purpose, you are buying the house. Now you are buying the house. Of course, you are buying the house keeping in two things in mind. If you are using it for your own residence, of course, you are saving the rent. So it is a kind of an opportunity income. Okay. And then second, if you are using it for as an investment purpose, then there are two kind of income that you will consider. First, the rent receivable. Another is your capital appreciation in the property. Okay. Now say, now the market is in a buyout condition. Okay. So that's why you are getting a this buy-and condition means more the buyers, lesser is the salary. You have purchased it 50 lakhs, but the same conditions, buy-and conditions may not be prevail all over the life. There may be some time when there will be sluggish conditions, market conditions will be there. So at that time, your price may not get the same as you are expecting. But however, say the dealer or the we can say broker, you are making your mind whether I should purchase the same. They say, sir, you buy the house, okay, you will get it monthly rent of say 20,000 per month. For example, I'm saying. So now you will say, yeah, it does not, I don't have any harm. Okay, because if I am investing in this 50 lakh in this and I am getting 20,000 rent per month, somewhat it is getting like 1,20,000. Okay, I am getting the 1,20,000 per income. Okay, if I compute this 1,20,000 divided by 50 lakh, so somewhat I am getting the income of 2.4%. Okay, now in that case, if I after 5 years, this if I can sell this house 1 crore rupee, okay, then my income will be more, because for the per year my gain will be somewhat 10 lakh. So my return will be very nice. And why I am estimating 1 crore? Because of inflation. So some, of course, these inflation price of 1 crore is of course is there, but still I can bank upon this 20,000 per month, because this rent will be increased on say 22,000 in the next year, then 24,200. Ultimately, with the by the 5 year, it may go up to 30,000. So this kind of a income, regular income, is generally considered to be the factor for determining the value of any investment. And that's why intrinsic value is banked upon the same. Even the intrinsic value also consider the capital appreciation if it is likely to be. And generally, in case of inflation, it is likely to get, we are likely to receive this income. Now then we talk about the approach. Generally, we use the EIC top-down funnel, that is we shall see in the next slide. Okay, first we carry out economy analysis, then we carry out the industry analysis, then we come to the company analysis. And it has a horizon of say 3 to 5 years. Generally, the fundamental analysis horizon have a 3 to 5 year, because here the investment perspective is for the longer period, because we are putting a lot of efforts in carrying out the fundamental analysis. We are doing the research, etc. So our purpose here is to hold the asset or the security for a longer horizon period. Generally, it starts with the 3, but it can go up to 5 year or even more. But minimum it is likely to get a period of 3 years, unless and until some any urgent situation comes out, or any we can say unexpected changes take place. Now, when we talk about this security analysis, technical analysis, of course, it is a kind of a behavioral aspect. So generally, we take the clue from the visual market view. So it is generally demand by the psychology, supply and demand. It is just go by like chart. As I told you, demand is there, more, supply is less, of course the price will go. Even we can see that in a case of a IPOs, if we see the IPOs, even the companies who have a loss in their last year profit and loss account, profit and loss account, their IPOs are coming out at a premium. One second. So it is also demand and supply plays a big role. Then approach. Generally, what to start patterns and repeat and analyze the repetitive trend, because we shall see that for the technical analysis there is one important history, its horizon, the short term. Okay, it can be from day to day or even months, not more than months, because our purpose is to entering into the market at a lower price and exiting the market at a higher price. Okay, today when we are buying one share, just we are not seeing their fundamentals, whether they are making profit, etc. We are just, our purpose is to make the profit, so our horizon can be from the days to or even months, not more than it. Then there is a efficiency lens. It is the efficiency lens means, uh, we can say that it is somewhat relating to how the market react to any information, because it is somewhat analysis, it is somewhat relating to the technical analysis, or we can say that it is the extension of the technical analysis, where we analyze the reaction of the market on any information, because market reaction is very important. Somewhat I say you, I explain you. Say if the market reacts to any information slowly, then accordingly we can draft our strategy, or we can design our strategy according to the same. And if they react fast in a fast manner, of course we have to design accordingly. So I just give you a simple example. Say if any nowadays, what is the Google? If we say that Google Map, what is a Google Map? Okay, it is a reaction. Okay, it is a driver's reaction to the Google Map. Now, generally, there are two type of drivers. Okay, say I am coming to my office every day by car. So generally, I never use the Google Map, because I say I have my own route. Okay, so but sometimes some drivers have some person like me have a habit of using the Google Map. So they act according to the Google Map. So we can say that all person are not using the Google Map. So reaction to the we can say any action or any traffic jam is unexpected. Sometimes we say that we cannot generalize that if due to any accident somewhere on any road or any blockage on a road, there will be the no traffic, because all are using the Google Map and everyone will use the alternative route. Because here we are kind of a mixed people. Some are using, some are not using. So that's why we have seen that in a most of the roads, if there any blockage, the traffic is there. So it is a reaction of the market. Similarly, for the any news relating to the company, relating to the industry. Okay, and approach, evaluate how quickly the data is priced into it. It is how it is discounted. We can say that how the price is discounted. Thank you, Ravinder. Uh, it is basically the prices. It indicates, okay, we discount the information. It is indicated by the price only. As I told you, now when the news spread of that the paracetamol will consume we will treat the COVID, or it will release the or reduce the chances of catching the COVID. The moment it reacted, it vanished from the. So even sometime we have seen that the prices of the start, it has gone into rising of the medicine because of black marketing. So it is a reaction. Okay, it is reflected in the price. Premises, market discounts everything. Market discounts everything means if any information has come into the market, of course price will be impacted, but at what pace it will react, these are the different theories are there. Okay, there are strong form of market efficiency, then semi-strong form of market efficiency, then weak form of market efficiency. So it is the reaction or the say pace of the reaction of any information reaction to the market is differently analyzed. It depends upon market to market. One second. Now there are two type of approach. One is uh, top-down approach. Another is down top approach, or we can say the bottom up approach. It is the basically what is bottom up approach. Now when we talk about the top down approach, and that is today's topic of discussion, and we shall move in this direction. Now here we shall see the first we come out with the economic analysis. As normally I give a very good example, and this is a brick nation. Somewhere around in 2007 to 10, the BRICS nation means Brazil, Russia, India, China, and South Africa. So these were the somewhat five economies. Economies were identified in somewhere around 2007, 8, or we can say up to the 10, for the making the investment, because their growth rate of the GNP was on a higher, very good. So in this case, what happens? We analyze, say generally these are done from the investment banker point of view, and these are generally by the foreign institutional investor. They what they do, they carry out the overall analysis of the economy. Okay, so if the economic growth or the GNP is a good, so they compare in which country we should invest the money. Here, when we carry out the economic analysis, of course, there are both in all analysis, we shall consider two top factors are there. One are the qualitative, another is the quantitative. Okay, so generally qualitative factors are generally open economy, closed economy. These are some qualitative factors that determines our decision. Say if any economy, the growth is a good, but they are a closed economy, they don't allow any foreign investors to invest their money here. So of course we strike it out. We don't go for this country or economy to making the investment because these are the closed economy. Okay, and there is another factor. There is an economy which are open economies. So of course we shall choose economies that are welcoming the FDI or FPI. So of course we shall opt for this economy. So generally we are concentrating our research to the FPI, because for FDI means we are investing in any business directly, but FPI means we are making investment in the shares or the debentures of a particular country. So in financial securities of any country. So here the analysis, we can say that the circle of our analysis, or we can area of our analysis is quite wide. Okay, so these can be variables like GNP, employment rates, that we will discuss when we shall discuss the topic of economic analysis. Now, when we come to the topic, next we carry out the industry analysis. In the economy, first we have identified one economy. Now in the economy, we identify the industry, in which industry we have to invest the money, because there are what is industry? As I told you, these are the group of companies that are in the same line of production of services or providing of services. Now once we have identified, say in somewhere around in 2008 or 7, India, say any investor has identified India as an investment destination. But when he analyzed the Indian economy, he found that there are many industries are there, like IT industry, real estate industry, construction industry, commodity industry, okay, and even we can say that hotel industry. So there are many industries were there. So now here he start analyzing in which industry I should invest the money, so that my money got appreciated. So at that time, IT boom was there. So of course, he must identify IT sector there. Okay, then it comes to the in IT sector, since there are variety of companies are there like Infi, now it is Infi, or we can say it is Infosys, TCS, Wipro, Patni Computer, that I think it was used to be on that time. I think it has now been acquired or something. I don't know exactly the state of Patni Computers, but I remember that at that time Patni Computers was also one of the company. So now when the different companies are there, now question comes in which company I should invest the money. So here he will establish a benchmark. Okay, I want minimum this much of return. Above this return, which company will give me the return? I most highest return company providing, I will go for the same. Okay, strongest performer with the chosen sector. So once we have chosen the economy, then we have chosen the sector. Then in the chosen sector, we go for the strongest economy. Now, this is a top-down approach. There is another approach that is called bottom-up approach that are generally rarely used, but these are used by the small investors. They go on the reverse way. Okay, of course, generally, retail investor does not have a choice of making the investment in outside the India. So generally, their analysis come from vary from company analysis. Here, the say direction moves like this: company analysis, then we come to the industry analysis, then we move to the economy analysis. Of course, this is analysis are there, but generally these are used by the retail investors, and generally they have a no choice for the economy. Their selection is limited to this much only. So generally they go reverse way. Okay, I want to invest the share in this company. Say they say that I want to invest in the Infosys. Okay, then they choose that okay Infosys or the Wipro. Okay, they go for which share I have to buy. Now in that case, what they say, uh, okay, they have planned their money to invest in any company there. But one of their friend told, yeah, why don't you to buy the share of Hindustan Unilever? Okay, then he will say, of course, yeah, consumer industry, we can say consumer goods industry is there. So why don't you go there? So now here he will drop his idea to invest in this. Then he will move to HUL share. From HUL, he will say that. So by that he doing the reverse exercise. But generally these are for the very rarely used. Of course, in the most of case, it is a top-down approach is there. So overall, we can say that our analysis comes into this picture, or you can flow chart. We gather the input, we carry out economy analysis, industry company analysis, then we apply the asset valuation model, fundamental analysis. We calculate the intrinsic value, that is justified price. And we match it according to our risk return profile. It is very important. So it is a matching with the risk return profile is very important. Of course, the a share may be, say there are two share. One is rupee, because generally face value is always somewhere same. 10 rupee face value share. One company's share is 1000 rupees. Another company share is 100 rupees. Okay, so it will be my risk return profile, because tomorrow if I have a 100 rupee for invest, say I have a 1000 rupees. Okay, so if the price goes down, market goes down, the price comes 900. Okay, if the price goes down, the share become 90 rupees. Of course, my loss here is 10. Here my loss is 100. So it depends on my risk appetite up to how much loss I can bear. Okay, so that we have to see. Okay, students. Now, so let us start our discussion with the first point. What is economic analysis? This is this slide I have taken from your uh, this is Saransh, the last mile referencer. I think you must be knowing that we have come out with the one last mile referencer, Saransh. Okay, from where we can say it is a somewhat a short or small notes or in a graphical mode or past card. Generally these are also used as past card. So for the last time revision, quick revision, their book is there. You can purchase it or you can order it from the website. So it is one of the very good exercise. Instead of doing all marking all the, of course mark you can do your study material, but as a quick revision you can refer the same. Now when we talk about the economic analysis, generally it is used to forecast national income with the various components that have bearing on the concerned industry and the company. See, economy is one of the important factor that determines the industry's growth as well as company's growth. If the economic growth grow, industries are there in industries somewhat, not all industry, but some industry will also grow. When some industry will also grow, the companies covered under this industry also grow. So the basic purpose is basically we start with the computing the national income, because it is the national income that is generally the main criteria for determining the growth of any business. If the economy's national income is growing, okay, of course, all the it is a consumable income. Consumption level will rise. Okay, so when consumption level will rise, more business will be there. Okay, more business will be there, and even demand will be there. Supply is less, more business will be established, more income will be there, and even national income also consist of net import, net export as well. If a company or a country or economy has a good net export, that is export minus import, have a net import, we can say import export surplus, positive surplus, export minus net I think it is called net export surplus. They have a positive net export surplus. The economy goes good, become very good destination for investment. And generally, when we shall discuss the topic of foreign exchange exposure and risk management, there we shall see that it is the national income, or we can say it is the economic growth that determine the value of the currency of any country. If their GDP is growth is good, their national income is good, so their currency becomes expensive. Okay, their currency become expensive because their product they are ultimately become the world trade leader, and their country, and like USA world trade leader, so that's why dollar demand is there. Of course the concept of petrodollar is there, but that's why what they have dominated the growth. Okay, so that's why the national income, or we can say per capita income of the USA and India, there is a huge difference, and ultimately that determines. Now once this per capita income comes on rising, of course the more and more companies or more an investment banker start looking to India as an investment destination. So these are some like factors affecting like growth rate of national income, related measures. Okay, growth rate of industrial sector, inflation is very important factor. Okay, because I think you must have studied in the paper of economics. Of course, inflation is good, but too much inflation is not good. Okay, inflation is accompanied by the growth in employment. Okay, is a good, because of course inflation, because more and more people are employing and their spending power is increasing and they are paying more for the goods, so it is a good thing. But if this inflation is rising on account of higher importing cost, then it is not good. So inflation level is very important factor, and this inflation is also determines the foreign exchange rate risk that we shall see. We shall discuss the topic of foreign exchange. It also another very important factor is determining the foreign exchange rate. That right now just only keep in mind that is also a factor. More discussion we shall discuss when we shall take up the topic of foreign exchange risk. Then another factor is the monsoon. A country like in India, monsoon is very important. Okay, if the monsoon, say this year, I think there is a report that the monsoon is not good. So the chances of the food product like wheat and other crops that are generally, I think it is not wheat, it is the rice. Generally, these are dependent on the this monsoon. Their production will be less. When there will be production will be less, of course, the companies who are already in the business, they have already holding a old stock. Their growth is more because they will sell it them at a higher prices. Okay, and somewhat we can say that a company but for the economy point of view, the overall monsoon bad situation does not as a good symbol because ultimately lesser production will be there and lesser growth will be there. So monsoon is one of the very prime factor. Of course, nowadays our economy is more dependent on the service sector, but earlier our mainly source of income was we used to call agricultural economy. So in agricultural economy, if the monsoon is not good, so our production will be less, rice production will be less, and our consumption. But we have to import more. When we have to import more rice or the food product from the outside India, then of course we have to make the more payment outside India at expensive rate. So our ultimately growth comes down. National disposable income comes less for us. Then what are the techniques used for the economic analysis? Now, when we talk about the techniques for the economic analysis, some are anticipatory services. Okay, these are generally, we can say like that, we are taking the surveys on the future opinion, opinion about the futures. Okay, we take this opinions of what are future state of economy. So on that basis, we can draw what will be the economy will be go, in which direction economy will go. See, student, I tell you one thing. Sometimes it also very important that if there is a growth, say if I see that in my neighborhood there is a one I give you a very good example of the same. It is somewhat we can correlate with economy. Somewhere around 2007, the chartered accountants are starting getting very good jobs. Okay, I remember that somewhere around 2007. Uh, Before that, of course, chartered accountants, before 2003, the chartered accountants were paid, of course, they are paid, but their pay package may not be that much comparing to the other profession. But somewhat post 2004, their packages start going up. And I remember that somewhere in 2007, our campus placement was one of the very good campus placement. So once, like, and even I remember that some students who are newly qualified in our locality, they were getting the pay package even more than me at that time. So by this, looking this, what we see, oh, chartered accountancy profession is grooming, or we can say it is grooming. So we should generally parents start looking for the. Earlier there were no knowledge about the who is a chartered accountant or what is about the chartered accountant. But once the parents of the young generation or the kids start saying, oh, it is a good option, so they start looking for the making their child prepare for the chartered accountants examination. Similarly, when the surveys are generally based on the analysis, so generally these are based on the sentiments, and if we see the growth overall, of course we shall be positive about the economy. Then there is a barometric or indicator approach. Now these are three indicators. Okay, various indicators are leading indicators, coincidental indicators, and lagging indicators. Leading indicators are generally those indicators that tell us in advance of the total economic activity and used to anticipate the shift. Okay, so generally, see, these type of we can say the indicator like that gives you some hint in the advance. what will be the growth is likely for the economy. Now, money supply means the government is printing the more money. When the government is printing the more money, so then here there are chances is that uh, inflation will be there. No corresponding growth will be there, but inflation will be there. So of course the country's prospects is not good. Then new manufacturing orders. Sometime a country like in India recently, there was a news that Indian government had received a defense order from some countries of worth rupee $1 billion. So somewhat it is a kind of a positive sign. Okay, even some company may be trying, maybe looking to establish a chip manufacturing unit in India. So these are indicators that once the order of the defense is there, chip manufacturing unit will be established here. So of course, there will be growth in employment. When growth in employment will be there, then growth in national income will be there. So these are all the positive signs. Okay, so these are somewhat leading indicators that are hinting that economy is likely to grow in some future point of time. So these are, we can say that these are leading indicators. They give some, we can say that from some happenings, we can foresee in what direction economy will go. Then coincidental indicators like this, these are in tandem with variables that move in tandem with the current economic situation on a real time snapshot. It is a real time. So generally these are current industrial production index, how the market is going on. And generally here one more index is there. We can say that stock market indexes also plays a role. If the economy is grooming, or we can, if the economy is booming, then of course the stock market index also goes on a higher side. Somewhere around in 2007-8, the stock market is going on a higher side. Stock Sensex was going up, Nifty was going up, because overall sentiments for the economy was positive. So that's why the demand of the securities are more. So overall Sensex was going up. Then lagging indicator is somewhat kind of a rear mirror view projections. Somewhat it shows when economy, something has already happened, something already happened in the economy, then we judge whether economy is has growth, or growth has taken in the place economy, or not, no growth has taken in the place in the economy. Now for this, generally outstanding industrial loans are one of the important. If huge loans are outstanding, so it means there are no income with the industrial houses to repay the loan. So it is not a good sign. They have taken a huge loan, but they don't have a capacity to repay, because there is no that much of sale, that much of income, so that they can repay the loan. Similarly, prime lending rate, MCLR or LIBOR. LIBOR generally is no more. Now it is SOFR. Okay, Euribor. Generally, MCLR are also, we can say, benchmark rates are there. Some lending rates are like repo. Repo rate, you have heard in the newspaper that repo rate, that is repurchase lending repurchase rate. So repurchase rate, it is the rate that we shall discuss in the topic of money market instrument, security valuation next chapter, where we shall discuss the money market instrument. So repo rate is that rate at which central bank or RBI gives the loan to the banks. Okay, the procedure is that actually basically the term is repurchase agreement. Okay, repo rate means repurchase agreement rate. Repurchase agreement rate means in this, what is the procedure? It is a kind of an agreement where one bank sells the security to the central bank with an agreement to repurchase back it. Okay, so it is the rate at which, because they repurchase at a higher rate, they sell at a lower rate and a higher rate. The difference is generally due to repo rate, and this is repo rate determines the economy's direction. If the repo rate is higher, so it means more and more industrial productions are there, more and more requirement of loan is there, and because the economy is grooming or booming. So this is an indicator. Similarly, LIBOR rate is generally for the international lending. So, and it is not determined the central bank, it is determined by the some group of banks. But since LIBOR has been discontinued because there was some scam of Barclays Bank earlier, there was, so now from the 2023 it is no more in use. Now instead of that we are using some rate like SOFR, Euribor. These are rates are there. So these are some lagging indicators that gives where the economy has gone. Now, when we talk about the this techniques of economic analysis, so somewhat we can say that there is one method of economic building approach. In an economic building approach, what we do, we make some models. Okay, we make some models. Like, see, what is model? If we say that, say when we were talking about KE is equal to D1 upon P0 plus G. So it is a kind of a model. Okay. Now I think you must have studied at your intermediate level in a paper of financial management, but more discussion we shall do on the topic of capital asset pricing model, CAPM model. There the model is like this: RF plus beta into RM. So these are kind of somewhat models. Okay, similarly, when we are carrying out the economic analysis, so there are some models where we draws out some models and where we put some data and we analyze the result. Okay, so independent variables are the cause. We put them in a model, we put their computation, and ultimately result comes. Okay, similarly, when I told you for the P0, the model is D1 upon my KE minus G. Okay, so P0 is basically dependent and independent variable. We can say that D1 KE may. So when I put these values in this model, these three values, I get the value of dependent model. Okay, student. So this is we say an economic model building approach. Okay, now how it moves? There are some steps. One second. Hypothesis determine the total economic demand. Okay, for example, then forecast the components. Okay, then aggregate, and then we validate our result. See, it is very important that when we talk about the economic model approach, it is very important that last part is very important, validate. Sometime what happens, we have come out with some results. So it is very important that this result should be verified or this result should be matched with some independent agencies. Say, if I give you a very simple example, of course, from the hypothesis we have determined, okay, it is likely to happen, it is not likely to happen. I presume that all using my Indian, this is all the economic building approach. Say, I determine that, for example, I'm just saying, for example, the rating of the economy, say of the Indian economy is AA plus. Okay, somewhat economy, or we can say economy is I'm rating this Indian economy like this. Okay, now there are some independent agencies as well, like Moody's. Okay, Moody's, international agencies, Moody's, S&P. So now say tomorrow, same result, I need to verify whether the Moody's is giving somewhat rating to my Indian economy is somewhat AA. Of course, positive is not there, but there's no. Now, suppose if they gave the rating of BB plus, then it is a matter of concern for my analysis. Why? Because I have done this. There's a lot of variation. The difference is this. I give you a very small example. It is a very, don't take it as advice. Generally, student mind it and say, if you go to for you have go to CA examination, okay, Now you have attempted the question paper, you come out, okay, it is a normal tendency, and it was also with me. We generally estimate our marks. How we estimate our marks? Okay, I have done this. 1 second. How we determine the marks? Okay, I have done this much of question. I have left unattempted. So it is kind of a model analysis or so what do we do? I analyze that and I estimate that I will score 60%. Now, of course, this 60% I cannot challenge that I will receive the 64 because ultimately when sheets are evaluated, now how much marks I will get, I may be considering one answer might be as a wrong answer, but it may be possible that it is a correct answer. Okay, so suppose now say if I receive a marks of 65%, so I can say that of course the marks are nearby, no problem. So my estimation has gone well. The problem comes, it comes both way. Problem comes both way. If it is too much higher and it is too much lower. Now, if the variation says that you receive the marks of 40, then it is a surprise for you. And still, if you receive a marks of 80%, then it will be also a surprise for you. Okay, you will say, yeah, how I received, I could not get the. So I tell you, on the lighter side, I share with you. When I in earlier days when I used to come by taking the exam, when after taking the exam, when I used to come to my home, so my father used to ask me, "Beta, how your exam gone?" So my answer was, "ठीक ठीक गया, ठीक गया, Papa, ठीक गया." It is ठीक means in English it is somewhat okay. Now what I used to do, say if I get the marks on the lower side, say 45, so I used to say, "Papa, मैंने कहा था ना, ठीक ठीक गया." Okay. But if I used to get a good marks, I say, मैंने कहा था ना ठीक हुआ है. So that's why on the lighter side, I am saying I am keeping the both things in my hand. So, but I say it is basically we have to get validate result somewhat from the internal agency, some external agency. So by this, we can say that it is economic building model building approach. Now, next is economic, how we catch the economic analysis. These are the some points. These are steps have been given in your study material. Okay, we start with economic analysis. Okay, these factors are there: political stability, rate of inflation, change economic level. So these are there, and ultimately, what outcomes comes, it becomes determine the total income and GNP, and ultimately this impact the demand. Okay, next is these are the four consumption pillar components of pillar economic analysis: consumption expenditure, GDP or investment, government purchase and services. It is one of the very important criteria nowadays. Government spending also matters a lot. The government spending too much on the infrastructure activity. So infrastructure activity, there is a growth symbol in the economy because ultimately they are making infrastructure very well. The net export is one of the very important determinant. So all these are the components, pillars of the economic analysis. What we do, we add up all this, then we can compute this total GNP. Okay, this in order to tell you, you must have studied in your macroeconomics paper. Okay, when this internal GNP, whatever you get, okay, you can get it tested by any external agencies. Therefore, so these were the economic analysis, or we can say economic approach was there. We have discussed. Now, next analysis, we are coming to the very important quickly industry analysis. So now when we talk about the industry analysis, what is industry analysis? When an economy grows, it is very unlikely that all industry would grow. Very important. Please underline this line. This line is from your study material. All industry will grow is not guaranteed at a same rate. Of course, all industry will grow, but all industry will not grow at a same rate. It, an industry can grow at a faster rate. So it is necessary to examine the industry specific factors in addition to the economic wide factors. For example, as I given you the example, like when India has received a defense order, suppose 2 or 3 countries more also give the defense order to the India. Now, in that case, of course, economic growth will be there. Other industry will be also grow. But one of the important industry that will grow, which industry will grow? If we say that at a higher rate. Now I want the answer from you students. Yes, it is a defense industry. Okay, it is a defense industry that will grow at a higher place. Similarly, when there is an agreement for like any country, we have any friendly relationship and they're saying, okay, we will give the, you can set up your BPOs or we will give the BPOs business. Okay, our outsource our business to the India. And that's the reason why India has grown in the last 20 years somewhat, because it is the growth in the outsourcing business in the India. And in India, BPOs are there. Okay, when BPOs are there, so they are getting the business. So in that, IT industries scope has increased. It depends. Similarly, if the infrastructure industry, or we can say if the infrastructure growth is there, so cement industry, okay, these industries will grow. So it is very important to which industry will react for the economic growth. This is one of the industry analysis criteria. Now, one of the some other factors that affect the industry analysis. These are the factors affecting the industry analysis, like product life cycle, demand supply gap, barrier to entry, government attitude, state of competition in the industry, cost condition and profitability, and technological and research. See, student, these are the some key factors that affect the industry analysis, and generally we have to see and we have to analyze these factors, and we have to make a study of these factors to understand the industry's pulse. So let us start with the product life cycle. It is one of the very interesting factor, and I need to tell you what is product. And I think you must have studied this product life cycle in your earlier paper, some other papers, like I think it is in your management paper as well. So what is the product life cycle? Product life cycle is a cycle of any type of industry. Okay, so there are 4 stages are there: pioneering, expansion, stagnation, and decay. Okay, when we are uh, talking about the pioneering stage, in a pioneering stage, survival of the fittest is the rule is there. Of course, when now in today's time, there is what are the pioneering industry is artificial intelligence. You can suggest one more name. I want from your one of just suggest name of the pioneering industry, but that is coming to your mind. Just share with me in a chat box. You share with us so that we'll discuss upon the same. Any point in coming to your mind? Any other product or any other industry? Blockchain, yes, you can say it. But blockchain is a part of, okay, yes, you can say it is a point of IT industry. And there is one more thing I want to discuss. I want the answer from you. Just guess it. You may. And this industry has been suggested by me by any one student in our last earlier session, somewhere around 1 year back. Okay, there is, if you have heard the name electronic vehicles. Okay, if you have electronic vehicles is one of the industry which is in a pioneering stage. Okay, research are going on. Okay, because due to the limiting the consumption of fossil fuel, and keep uh, the due to it coming of the concept of sustainability. Now there is a efforts are going on to come out with electronic cars. Now you must have seen that now cars are moving, their number is increasing because the cars with carrying the green number plate are electronic cars. Okay, now their number is going to increase day by day on a road. Before 3 to 4 years, I remember that hardly there used to be we see one or two car, but now when I coming out, so at least I on my way to my home, at least I see 4 to 5 cars a day every time one route. So now it is a pioneering industry, and here the small players vanishes. Only the player that have a money to sustain, because here there will be loss. Okay, profit will not be there. Okay, so here it will be loss, and here only the industry that will have a huge capacity to sustain, they can survive. Now next stage is this expansion stage. Here the profit start coming. Okay, here the profit start coming and companies start earning the profit. Okay, in today's time, IT industry and the pharmaceutical industries are under in this category. Okay, because now a new new and even one thing more, there is cyber security. Of course, it's a part of IT industry, but cyber security, due to cyber increasing the importance of cyber security, more and more companies are spending too much money on the cyber security and giving the contracts to the IT industry. So they are having a huge profit. And there is one more important reason for the high profit of the IT industry. It is because of foreign exchange rate that we will discuss when we shall discuss the topic of foreign exchange. Then there is a stage comes the stagnation. Here in this stage, this is a maturation or a maturity stage. Here the growth start slowing down. Okay. In today's time, if we see that the demand for the manual gear car is coming down, more and more moving persons are moving for the automatic gear car. Okay, because they move then so manual gears demand is coming less. So in that case, that the companies which are more in the companies, or we can say that which are the industry which are providing such type of accessories for automatic car, they are in the this expansion stage, or the companies which are in the production of gear manufacturing companies, their industry, they maybe have a lower demand. Okay, so this is one of we can say it is a maturity stage. Okay, similarly, like here in the real estate as well. Now today's, if we see that, like we are in a, if we see that we are Delhi NCR based. Okay, we are our office in Noida. Now what happens in the 5 to 6 year back, the prices of Delhi's the properties that are available in the Delhi region only. Okay, only Delhi. They were on a higher premium. On the other hand, the properties available in NCR region like Gurgaon, Gurugram, Noida. Okay, in this area, the properties have a low premium. But with the increasing the number of opportunities in these NCR regions, what happens? The properties of the price has shoot up. Okay, so they have started expanding, but today they have ultimately come to the stagnation. Now, more than it, if of course the price will be there, but generally now they have started pricing is the stagnating. Now then we come to the stage of decay. Okay, these are the industry that does not have prevails more, and there is one more industry which I give the example like expansion is a LED bulb. Okay, LED bulb is now it is in expansion state and we are using the same. Now here filament bulb, filament based bulb. Now they are rarely available. Okay, no, because they consume too much electricity. Now in the most of the shops and everywhere you will see these are the even in a light poles. The government has replaced the filament bulbs with the LED bulbs. Okay, LED tube light. So these we can say that it is somewhat kind of a product life cycle is one of the very important criteria for the industrial analysis. Now another is demand and supply gap. Automobile industry is a petrol automobile industry, we can say petrol automobile. Okay, electronic vehicles will take place and petrol industry will move on. Okay, they will come into the of course decay stage. It times are come generally. Uh, if you see that nowadays even the cycles sale has come down, but there was a time only. On a lighter side, I just share with you when my father and say they got married at that time. Generally, the in the dowry, somewhat say they girls on from the girl side, the they used to give a cycle to the groom. Okay, but now the cycle has been shifted by the motorbike. So cycle industry we can say in the somewhat in a decay stage. So now few people, of course, some labor or some limited people are using the cycle. So cycle industry has come down. We can say in the decay stage. Transistors, yes, Ravinder, you are right. I was also discussing that transistor was used to be also there, one of the very important. But now nobody use that transistor. Radio. Okay, very good example. Then there's a demand supply gap. Demand supply gap is very important because from this we can realize that if the excess demand is there, then an industry can achieve the super profit. Okay. Somewhat I remember that somewhere around in 1990, when the color TV, you must I think student you have never seen the black and white TV at all, because once you have come into this world, you from the day one you was watching the color TV, but there was a time when there was a black and white TV used to be there, and somewhat in around late 80s the companies, I think at that time there were two companies in India. There were one Onida and another company was of course, Videocon has come later on, but there was some company like Panasonic. So there are only two companies that were manufacturing or assembling the TV in India. Parts were importing from the Japan. So Videocon has come, and some two or more companies like Akai. These companies. So when this company has come into there, so their demand of the color TV has start rising. Okay, nobody was buying the black and white TV. So at that time, industry's demand was higher and production was limited. So everyone saying, I want color TV, VCR. That's I remember that VCR, VCP were in very demand. So at that time, the that industry reaped the benefit of the high profit. Similarly, if the excess supply is there, then the margin degradation there. The margin start reducing. Even until the capacity exits the market. See, every company have industry have some capacity to produce some goods. So what they do, they say ultimately this minimum will be production will be there. So ultimately this capacity will be reduced, the production will be there, and ultimately this will be will be sold at a lower margin. Then barriers to entry. It is one of the very important. Now it has to be seen in which industry, what is the barrier. Okay, barrier means if say, because see ultimately this industry analysis will move to the company analysis. So generally in an industry analysis, it is observed that any industry in which मैं लाया हूँ अपनी in a we have to see in barrier to entry means we have to see uh, means if any industry in any one can enter in the industry, so there the profit margin starts squeezing. Okay, so sometime it is seen that ki where the industry whether it enjoys the monopoly like this. Now there can be many walls like capital requirement. Some industry may require huge in capital investment, massive investment, like chip manufacturing industry. Okay, so here the company will come only, there will be only one or two company can be there. Okay, they who will reap the profit. Similarly, intellectual property is one of the very important. Some companies may have some intellectual rights. Okay, no other company can produce the same patent. They have a same patent right. So they ultimately reap the benefit. Okay, some industry may have like they have their own patents, etc. Their companies there. Regulatory captures, complex compliance and licensing metrics. Like here I give you one example. Airline industry is a little bit complicated or regulated, too much regulated industry, because there the licensing requirement like airport requirement are there, like flying our pilots, so they huge require. So no, any company cannot easily enter into the industry. So generally their companies then enjoy the monopoly. So of course these industries, some where the complication, so these industries enjoy some kind of a monopoly. Okay, so when they employ the monopolies, of course the chances of making the profits are there heavy. Like airline, in an airline industry, there are only few players are there nowadays. Government attitude is very important. Now sometime government how treats any industry is very important. Sometime a government may say uh, put some additional taxes, so it is a discourage, it gives a discourage. Sometimes they may give some subsidies. Okay, they may put some okay, sometimes they put some environmental restriction. Okay, some they put the in this like for leather industry, government has put a lot of restrictions nowadays. So that's why they are somewhat declining. Okay, companies are shutting out their business because government has become stricter for the discharge of the effluents from the leather companies. Okay, price control is one of the very important. Okay, price control is very important. Earlier there was used to be cement industry. Even today the cement industry's prices are somewhat controlled by the government. The prices cannot be cement prices not cannot be left to the market determined demand and supply. Okay, it is one of the very important regulated price. Antitrust, MRTP. Okay, Competition Commission of India. Generally, sometimes government see that in industry there cannot be any one major player. Okay, so these are there, and sometimes target stimulus government can provide. Okay, you rise there, they provide cheap land at cheap space, etc. Favorable trade tariff, there from the foreign you can import this much. Infrastructure grants, so all these are acceleration determinants and these are the friction determinants. So government attitude is very important for any industry. Okay, now when we talk about the state of competition in the industry is a very important. Like in growth industry, Okay, these are three industries: growth, cyclical, and defense. Now, growth industries are growth industries that are generally in a growth mode. Okay, generally they normally keep on growing with the passage of time. Okay, like tech and biotech. Okay, why? Because more and more people are becoming sick. So generally pharmaceutical industries are growth industries, we can say. Okay, cyclical, generally these are dependent on the GNP, earning profile. Okay, then there is a defensive industry. Generally these are utilities and consumer. They have a stable, like food industry is a kind of a stable industry. Everyone has to eat the food. Nobody can say I will not eat the food. Okay, similarly consumer goods industry is a stable kind of industry where we have to consume the goods. Okay, now we can say that what is the state of competition? Monopoly is there, oligopoly, and fragmented. So in this, when the in this kind of industry fragmented, then these are in case of a commodities. Okay, so here the competition is more. Okay, in this competition is more, the margin is less. Okay, when the competition is less, of course margin is more. Okay, then one of the very important is cost condition. Okay, I need to tell you, you must have gone through this topic in your cost accounting paper. Okay, so now it depends. Generally, there are two type of industry. In a one type of industry, fixed cost may be higher. Okay, but variable cost may be lower. Now, in this case, what happens? Now, in this case, what happens? Say, as our volume increase, here we can see that our profit gone rising, but slight decrease in volume lead to a huge change in the margin. The industries which have a higher fixed cost have a more chances of swinging the profit due to slight change in the sale or the volume. Whereas on the other hand, the industry which have a lower fixed cost, higher variable cost, even some sale downfall may does not have a high impact. Why? Because especially in case of IT industry, okay, say if I say that, if I talk about the IT industry, in IT industry, our generally variable cost is on a higher side than fixed cost, because in the name of fixed cost, they does not have a major fixed cost. Their higher variable cost is a human resource cost. Okay, so tomorrow if they are not getting any project, so they can lay off some staff. That's why in tech companies the layoff is so much fast. On the other hand, if I say there is a manufacturing company, uh, there is any plant which operates with some minimum capacity. I can take any example like scooter, car. These are industry where the fixed costs are higher. Okay, of course, if there is any change in the sale of scooter, so it has a higher impact. But because minimum you have to retain some staff, because once you lay off the staff, tomorrow if the demand goes on upper side, you may not get the same staff. But on the other hand, in the IT industry, tomorrow if the demand comes, you can hire another IT professionals. So this is very important. Cost, condition, and profitability has to be analyzed. Then technology and research. It is one of the important criteria. Okay, because research very important. If the research, if the research, more and more research involved in any industry, lesser and lesser competitor will be there, because for research, too much investment has to be carried out. Okay, student. Now we start. Before starting, technique used in industrial analysis. Let's have a small 10-minute break. It is 8:39 by my watch, so we will reassemble at 8:50, somewhere around 8:49. Okay, so 8:40. So we will reassemble at 8:50. Sanket ji, break start. Slide लगा दीजिए. Okay. संगीत जी शुरुआत कीजिए. Start. Okay. Welcome back, student. Now we have left the at this techniques used in industry analysis. So first is regression analysis. Another is input output analysis. Now when we talk about this regression analysis, what is exactly regression analysis? It is somewhat. I tell you. One second. It is a. I need not to tell you about the regression analysis because it is somewhat kind of a statistical technique where there is kind of some relationship exist. Okay, so we can say there is some correlation exist that is used to measure the strength of the demand relationship. Okay, we can say that some we put some variables in some equation, and then from that basis we can determine the expected demand. Okay, so for example, now these are some regression analysis variables like GNP, disposable income, per capita income, price elasticity of demand. Now, ultimately, on that basis, we can determine the demand of any particular product. For example, I give you an example. Now, if GNP is on a rising, okay, so then the demand for the luxury goods, okay, the luxury goods demand keeps on start rising. Similarly, when the disposable income increases, so people start spending on the automobile sector as well. Okay, now earlier there was used to be, as I told you, there was used to be a cycle, one of the very important vehicle, but now with the increase in net disposable income, now most of us are going on a vehicle industry like motorbikes, etc. Similarly, very important when there is an increase in the national income, hospital now has become an industry. We can say that private hospitals now they are more in demand because everyone wants a good health care. So instead of treatment at a government hospital, so most of the patients are now moving to the private hospitals. So with that's why in the recent time we have seen that many private players has come into the this hospital industries. We can say that, you know, now there is a price elasticity is a very important factor. See, price elasticity means there are two type. If I don't know to tell you about the same price elasticity, there are some products whose demand is inelastic. Whether there is more income, lesser income, they have to consume at all. Like food, food is a inelastic. Okay, it is their elasticity is zero. Okay, but on the other hand, luxury goods. Okay, their price elasticity is on a higher side because as more and more income will be there, demand will be on a higher side. So these are some kind of a regression analysis. Then there is a input output analysis. So input output analysis basically reflect how we can say somewhat it is kind of a supply chain relationship. It determines what is the overall procedure, like from what time it takes place from input to the output determination. So because ultimately depends in which direction the industry is going on. Okay, if the demand of the output is more, so of course the related industries products demand will also be more. For example, if I say the automobile industry's demand is going, automobile demand is going on, they are going further. So ultimately, raw material, or we can say related materials like iron. Iron is one of the main important constituents of the automobile. Okay, aluminum. So their demand is also start increasing. So in this mining industry is also become a very important because ultimately if the production of the automobile will go up, ultimately demand for raw material like iron, etc. will also go up. When their demand goes up, so ultimately what will happen? Overall, we can see that related input industry also booms. So this is one of the very important, and even related services as well. For example, another like now a coaching industry, if we talk about now with the coaching industry, ultimately now the time has changed. When we were used to take the coaching, we used to have it going to the physical location. But now today, if I am teaching you, but I am teaching you through the uh, online classes. Now these are online classes. You are watching us on your laptop system or the mobile even. So by this, what is the end product is rising is coaching industry, or we can say the education in edutech. We used to call it as a edutech industry. So with the rise of the edutech industry post COVID, and especially this is a rise in, so demand for the IT services has increased. Now there are more IT services related demand like cyber security and other factors are also important. So there is also a need to analyze the relationship between input and output analysis. Okay, so overall we can see that if we see here, it depends on the final consumption. If the final consumption is more, so overall everything is going on. When there is a saturation, this is the graph of saturation, and this is a declining industry somewhat graph. So from this we can analyze where ultimately the industry moving up. So we can see there are in that if we talk about these two comparison. Now for the core objective is demand forecasting. Here the structural tracking. We have to see what is the structural tracking, micro and macro both. Here the supply chain system we have to analyze. Here the key variables are GNP, income pricing. Here the flow of goods and intermediate step is important. Then correlation and strength, important ultimate output and macro growth and decline trend. Okay. Now we come to the next important criteria is company analysis. Of course, we have, say, I give you a simple example. We have chosen one economy out of many economies. So we have through the economic analysis, we have chosen one economy. Now, once we have chosen the economy, next we go for the industry analysis. In which industry we have to invest our money. Now, suppose if we have identified any industry, in this industry, there are many companies. Now we have to see in which company we have to invest the money. So here when we carry out the company analysis, we can say from macro to we have moved to the micro analysis. Now when we move from macro to micro analysis, here our analysis becomes more detailed. Okay, here our analysis become more detailed because here it is one action have an impact on our investment. Because earlier, if in an industry many companies are there, action of one company may not affect overall profitability of any particular industry. But here, once we have invested our money in the company, then our each and every action of the company matters a lot for us. That's why whenever we have to analyze the company analysis, we divide our analysis into two parts, two factors. We have to say consider qualitative factors and quantitative factors. Now, when we talk about the qualitative factors, so here some subjective management qualities. Here the things are not that much clear in black and white. Here some subjectivity factors are there. Okay, some like management, like what is the quality of management? Some may say that management is good, other may say no, the management is not good. It's everyone has their own perspective. Okay, then existing shareholder pattern, it is very important. Okay, how much share they have floated in the market, it is very important. Generally, we can say that the companies which have a high growth, their shares are more concentrated in the hands of the few investors. Okay. Similarly, marketability of share is very important criteria. Because why it is important marketability? Sometime if you want to exit to the investment, So then exit route is also very important. See, always please remember, whenever you are making an investment, in addition to entering, exit route is locating the exit route is also very important, because unless and until the exit route is not clear to you, it may be problem for you. Okay, money will be stuck there. Then other quantitative factors are like EBIT, earning per share, earning before interest and tax. Earning per share, I need to tell you, price earning ratio that we have discussed, dividend yield, okay, then free cash flow, liquidity available for strategic decision. Student, when we talk about the free cash flow, let us see what is exactly the free cash flow. Of course, you must have studied the term cash flow statement. From where we can see that cash from operation, cash flow from I think it is from investment, cash flow. I don't remember it. One is investment. Other element, can you remind me? Cash flow from operation, from investment. There is another sources. Financing. Yes, I was writing it as a source. Yes, Manoj, you are right. So it is a financing. Okay, from operation we consider profit and loss. Here we consider our new sources like debenture or repayment, etc. Or here the investment is generally fixed assets, purchasing, etc. So ultimately, let us know about what is our cash position. Okay, but there is a term free cash flow, means whenever we earn the profit, this profit is not exactly the equal to our cash inflow in the business. Okay, why? Because when we were talking about the capital budgeting decision, okay, there was term cash flow. Okay, there was term cash inflow. So where what we used to do, we less the depreciation from it, debt from it, whatever the profit after depreciation, we less the tax, and from profit after tax we add back the depreciation, because depreciation is a non-cash item, and ultimately this cash inflow we used to consider for our calculation. But when we talk about the free cash flow, generally what we do, of course, from profit we add back depreciation, but we minus the acquisition of new fixed assets. Okay, if any further addition of any or we can say that repayment of any loan. Okay, so these are what is ultimately, it is generally, it is that this much of cash is available in the business. Okay, so there are two terms are associated that we will discuss in the topic of free security analysis: free cash flow to firm. Okay, free cash flow to the firm and free cash flow to the equity. Okay, free cash flow to the firm means ultimately that is cash available for the firm at their disposal, and free cash flow to the equity, that is free cash flow available for the equity shareholder. So this is terms are there. So this is one of the very important criteria for making strategy decision or making investment. Generally, companies with have a free cash flow, high free cash flow to the equity, their shares are at a premium because they have a more profit at their disposal. They're more have a more cash or available for making further investment. Now these are some quantitative fundamentals like net worth and book value. Net worth, I don't know to tell you, it is basically, we can say that profit share capital plus reserve. Book value means of the book value of assets, sources and uses of the fund. One second, I Okay. What is this sources and uses of fund? There was used to be a term called fund flow statement. Now it is no more in generally. I don't think it is no more in teaching, no more in studying. Fund flow statement was used to be like from where the funds have. There are, we used to call it sources, and there was used to be a uses. Okay, so here we used to exhibit show from where the funds have come, okay, and where it has been used. So ultimately, what is our fund position? These are used to be very important indicator for the company's performance. Okay, now it has been replaced with the cash flow statement. These are almost both are equal, but earlier there was used to be fund flow statement because that is more related with the net working capital, current assets minus current liabilities. Then cross sectional and time series analysis. Cross sectional meaning common size statement. Okay, generally it is considered a common size statement. Generally, here what we do, we for making the comparison with the industry. See, every company have their own sales, okay, their own volume. So we cannot compare the performance of a two company or three or more companies just on the basis of revenue. Okay, there may be some other basis because see, I just give you a small example. Is a very good example. Now say there are two students. Okay, there are two students. There is one, say Mr. There is student X. Okay, yeah, okay. Let us take an example. There are two boys in our locality. There is one boy X, another is Y. Okay, now result comes out. Okay, now X says, I have scored 500. Okay, and Y says, I have scored 1000 marks. Now, on the initial basis, what will be our reaction? Ki who has performed well? We will say, oh, why? You are very intelligent. You have worked very hard. Although, okay, so on the basis of this, we are appearing that Mr. Student Y, boy Y has performed well. But when we ask how much, out of these marks have been out of how much, then X says, I have scored these marks out of 800. Okay, and then we ask why? Then he says, I have scored these marks out of 2500. Now our perception is changed immediately. Why? Because Y has scored only 40% marks. Okay, on the other hand, X has scored 62.5%. Now who is performing better? X or Y? Of course, X. So this is a common size statement where we convert the revenue as a basis of 100, and then accordingly we start deducting, or we can just show how much part pertains to the cost of sales, how much part pertains to the raw material, then wages, all these are, so by this we can make comparison. Okay, which industry company is performing how much, because volume cannot be the same. Okay, now that's the reason sometime we have seen that a company may be a very small company, but they are performing very, very well. Of course, their volume, not their sale may not be that much. Okay, but due to their huge turnover, their less effective, efficient working, they have a high margin of profit. On the other hand, a company may have a higher volume revenue, but they're not that much efficient. Of course, money wise, they are performing well. Overall their profit may be higher, but when we compute the and when we but their efficiency is not that much, their percentage of the earning is not that much. So that's why here the earning per share plays a very big role. For example, there are two companies, A Limited, B Limited. If I say profit after tax and preference dividend, of this company say is 1 crore, and this company say it's a 2.5 crore. Okay, on the initial screening, I will say this company is performing well. Okay, of course, money wise there. But if I say number of shares, this company has a share of 50 lakh. Okay, and this company say, sorry, it's not 50 lakh. Say it is a 10 lakh share, and it has a 25 lakh share. Sorry, this company has a 1 crore share. Okay, now here the EPS will be rupees 10, and here the EPS will be 2.5. So we can see even a small company having a profit of 1 crore may have a better prospects. Okay, student. So this is kind of a cross-sectional time series analysis. We also analyze from the one period to another period as well, how they have performed. Size and ranking. Market leader are there, whether sometime a company may be a market leader. Okay. And when it is a market leader, of course, their chances of exiting the market are very least. Growth record. It is very important. Okay. The company will have a higher growth rate, have a higher premium. That's why when we say that P1, that is when we say P0 is equal to D1 minus, sorry, D1 upon KE minus G. Okay, so higher the growth is there, more will be the price. Then financial analysis, it is very important. Financial analysis is a very broad term, and we shall discuss in the more detail. Here it involves the ratio analysis, all the factors. These are some qualitative techniques we analyze. All these are, we can say the analysis are quite subjective. Okay, these are analysis are quite subjective. Like here, we have to analyze the competitive advantage. Sometime a company may have a advantage of being a monopoly. Now, in this, I give you example of Indigo. Okay, Indigo has a huge base of the, and they have a more flights. So they have a somewhat competitive advantage. Once there was a crunch of staff in Indigo, it affects a lot of uh, operations of all the companies, because all the flights were cancelled, etc. So ultimately they have some competitive advantage. They have a more quality of management is one of the very important. Okay, quality of management is one of the important criteria, because a company with the sound management and good corporate have a good that's our companies are prospering well, and that's why the company if we have seen that some companies who have a, even they hire a good management people by making the huge payment to them, so that the quality of management can be improved upon. Then corporate governance. It is one of the important criteria nowadays, because it is one of the part of ESG. Okay, environmental, sustainability, and governance. Now these today the most of the companies are ranked on the basis of ESG analysis. So governance has become very important. The companies who have a high standard of governance, they enjoy a benefit, or they enjoy a premium, because every investor believes that the company which have a higher growth, higher level of governance, the chances of their manipulation of the money is least and least. So governance is very important. Then regulations. Now sometimes it depends on the companies. Some companies are more regulated. Once they are more regulated, of course, they are more controlled. So the chances of wrongdoing are very least. So like I just tell you before, it is a very common example. I just sometime I quote. before RERA, Real Estate Regulation Act, before RERA coming into the picture. So generally the companies involved in the real estate business were even sometimes doing very wrongdoings, because they were used to form a company, they launch a project and collect the money, and even sometime they declare themselves insolvent. Now they have to take a RERA license, and while RERA license is issued by RERA authority, they completely check all the documents, and whatever the documents are available, whether this project is likely to be sustained or not, because they are likely to give a hand over the project or not. So now the more and more regulations are coming, then company is so ultimately more believe investors start putting more faith in, placing more faith in this type of companies which are more regulated. Similarly, insurance sector. So insurance companies are generally insurance companies are generally regulated IDA. Okay. Similarly, banking companies by RBI. These are regulated. So these are regulated, and these are the regulators. So that's why the chances of wrongdoings are least and least. Then location and labor advantage is very important, as well as management relation. Okay? Location means location should be strategic. If you recall that sometime in the topic of business organization in your graduation days, there was used to be a topic where the companies which have a nearest to the location of raw supply of raw material, they have a higher profit because lesser transportation cost. Similarly, if the distance between, they see there are two things. One is distance from raw material supplied to the company, then after processing of the raw material into the goods conversion, then selling of the goods or the market where the goods are to be sold is another criteria. So these are location need to be used to be analyzed, so that one of the important factor, location advantage is very important. Okay, that's why we have seen that the shops which are locally like in, we are living in a Delhi NCR, and here the metro train is one of the very important criteria. So flats or the residential colonies and even business houses that are near to metro station enjoys a higher premium. Okay, because location advantage, that is using of the public transport. So it is one of the important criteria. Then labor relationship management is very important. If the company has a sole relationship with the labor, then there are chances that of strikes are more. So here the risk of the become more, that company may be in the trouble tomorrow. So that's why here we should the investor can say that, okay, well, I don't want to invest in that company. Pattern of existing shareholder is very important. As I told you, it depends what is a whether it is a promoter centric uh, pattern, because more and more promoter centric pattern will be there. Of course, the decisions will be one sided. Okay, more and more investment pattern is like that. They are more floated in the company. So decisions are cannot be one sided. They are generally on a mutual discussion or whatever with the common decisions are there. Then marketability of shares, I told you, it is a liquidity factor here, because once we acquire the share, so here the liquidity is very important. Otherwise, we shall exposed to liquidity risk. Now, what is exactly the financial analysis we have discussed? Now, we are discussing financial analysis in the detail. Okay, of course, we shall discuss one practical question in today's class. So, it is a kind of a financial analysis is kind of a, we can say this topic is kind of a revisit of your FM paper that you have discussed at the paper 6A at intermediate level. Okay, an analysis of its financial statement for past few years would help the investment manager in understanding the financial solvency, liquidity, efficiency with which the funds are used, the profitability and operating efficiency and financial and operating leverage of the company. For this purpose, certain fundamental ratios have to be calculated. So, first of all, when we talk about financial, so first is financial solvency. It is one of the very important criteria. Okay, and if you remember that, somewhat we used to calculate the current ratio. Okay, we used to call current ratio debt equity ratio. Okay, not current ratio. I think we used to calculate for the liquidity purpose. Okay, but it can also be used for your checking their solvency also. Okay, then your liquidity ratio. Current ratio and liquid ratio. If you recall that these are some ratios that because we have to see, and there is efficiency with which we are operating the business. Okay, that can be judged from the efficiency ratios. And these are generally turnover ratios. Okay, then profitability ratio that we will discuss, how much profit they are earning. Okay, then financial and operating leverage of the company, operating efficiency. Okay, what is operating and financial leverage? Please tell. Any guess? Yes, you are right. EBIT upon EBT. Ravindra, you are right. Similarly, financial leverage. Okay, is that am I right? Okay, so here the financial leverage and operating leverage means operating leverage is concerned with the fixed operating cost structure. Okay, financial leverage is concerned with the fixed financial cost structure. As we told earlier, the company having a higher operating leverage. Okay, if they have a slight change, it is that's why it is called double-edged sword. Okay, while any increase in the sale have a magnifying effect on the profit, any decrease in the sale also have a magnifying impact on the profit loss, decline in the profit. So both are, and that's why when we talk about the financial leverage, if our return on investment is higher than our cost of debt, so of course with the increase in the return earning, that is return or the profit, so we have a higher EPS. Okay, but if our profit or our earning before tax is reduced, so it has a positive effect as well. So this or we have discussed in our intermediate level. So now we will shall what we shall do, we shall have a quick revisions of these ratios here, so that our we get some get refresh our some concept, so that even if we are asked in the examination about discussing the any financial analysis of any company, so little bit we can do something. Of course, generally it is not expected that you have to carry out an in-depth analysis of the ratios, but you have some fair idea of these ratios. Okay, then we come to the various ratios, various other ratios to measure the profitability. Operating ratios and efficiency of the company may also calculate the return on honest investment is one of the very important criteria. Cost structure also worked out. Generally, turnover ratios are related with the efficiency ratio. Okay, all these ratios we shall discuss. So let us start with the quick summary of the ratios, and this summary I have taken from your intermediate study material. So you can have a look at the, of course I have taken a summary. Okay, you can have a some you have can refer the content as well, but I think even the summary you refer the same, then your all the concept will be refreshed. So student, let us start with the first, liquidity ratio. So liquidity ratio, as I told you, it is generally the current assets divided by current liabilities. Okay, so it measures the estimate whether the business can pay short-term debts. Idle ratio is 2. However, it is not, see, idle ratio is considered to be 2, but generally it depends from industry to industry. Okay, sometime in the IT industry, where the general liabilities are not that much, current liabilities are generally not that much, then there we can also consider 1 as well. So it depends on from industry to industry, but in a manufacturing industry, generally it is considered to be the 2 is the best ratio, because there the production process is goes on a regular basis. In IT sector, generally what happens, it is a project based work is there. So generally whenever there in as a slowdown, so we by laying off the staff or the other cutting short the expenses, this current liabilities portion can be controlled. Then quick ratio, okay, this is meet to our current debt immediately. And quick ratio, generally what we do, from the current assets we deduct our receivables. Okay, or bills receivable, we generally deduct it, so that whatever be the cash that is available, we can receivable. And I think it is a one, no, sorry, not receivable, I think it was, can you suggest, but it is a stock. Yes, you are right, it is a stock, not receivable, sorry. Okay, because stock generally have a, we cannot dispose of it as early. Okay? Now there is, see, I am just doing it here because I don't remember that much of, I'm just doing a quickly summary. Then cash ratio, cash plus cash equivalent divided by current average. So it is measure actually. Okay, Ravindra. Now, see, of course, we have to maintain, but for you as student right now, it is important for you. Then we come. There is another basic interval ratios. So far it is not that much is used, but I have put it here only. Cash plus cash balance plus net receivable divided by operating expenses per day. Okay, then there is a net working. Net working capital means current assets minus current liability is very easy. That need not to problem. Then we come to the capital structure ratio. Okay, it is very important. Then it indicates how much a owner's capital is involved in the business. So here it is the equity ratio. Okay, equity ratio means shareholders equity divided by net asset. Okay, it indicates the owner's fund in the companies to the total fund invested. Okay, then it comes the total debt ratio, total debt divided by net asset. Then very important, debt to equity ratio. Okay, it is one of the very important ratio which determines the solvency of a company. Okay, so of course higher it is, more risky the company, because if the company being a debt being a fixed source of capital, fixed we can say fixed charges, the source of capital, we have to pay the interest whether we have a profit or not profit. So if the unless and until the company is very solvent, or where they have a earning higher than, as I told you, their cost of debt, this company can run into the risk of insolvency if they could not earn that much of profit. Then there is a debt to total asset ratio, same, that how much our debt has been used to finance the asset. Okay, capital gearing ratio, it is very important, this ratio. Capital gearing ratio means how much fixed borrowing, fixed cost borrowing, fixed interest bearing to equity shareholder funds. Okay, so it is relating to somewhat financial leverage for the equity shareholders. Okay, proprietary funds, somewhat it is equity ratio. It is equivalent to equity ratio. So these are some other names. Then debt service coverage ratio, it is very important. Earning available for debt ratio. Then interest coverage ratio. Preference dividend, that is more. This is ratio is also important. Fixed charges coverage ratio, that how much fixed charges we can pay. Generally, it is considered that basically it is based on our cash flow, we can say. Okay, somewhat, because we are adding back. Then it is very important. These are efficiency or the turnover ratio. It indicates how efficiently we use our assets and other resources. Okay, the higher the ratio will be this, so higher the rotation. So it is something we can say that it is a kind of a rotation. Okay, it is somewhat ratios, generally efficiency or turnover ratios, somewhat it is kind of a rotation of funds. Higher the rotation, higher the ratio, higher the rotation, means with the less cash we are rotating the business, or we are doing the business as much more and more. Say I just give you an example. If I say I've just for example, I just share with you example. Say there are two companies, X Limited and Z Limited. Okay, it has a sale of say 1 crore, and it has a sale of also of say I can say, don't say we, let us see, this sale as a 2 crore. Okay, now of course sale of this company is more, but the asset this company is owing is say same similar type of a company, same in the same business. They are having a asset base of 20 lakh. Okay, on the other hand, this have a asset base of 50 lakh. Okay, now when we calculate the asset turnover ratio, so sales divided by assets, it becomes 5. Okay, rupees 2 crore divided by 50 lakh, it becomes 4. So now here we can see they have rotated 20 lakh 5 times. Okay, and this 50 lakh only 4 times. So it means whatever be the interest they are paying, whatever be the charges they are paying, they are making efficient utilization. Okay, so it indicates the efficient. So that's why it is also called the efficiency ratio. Okay. Similarly, fixed assets, how much time the fixed asset has been rotated, capital turnover ratio. Okay, capital turnover ratio, net assets, we can say net assets or capital employed. We can say it is somewhat capital employed. Or working capital turnover ratio, how much time working capital have been used. Inventory turnover ratio, how much time the inventory has been rotated, what efficiency. Then data turnover ratio, it indicates with what speed we calculate our, basically it is a collection. Okay, so data turnover ratio means average account receivable divided by daily average credit sales. So it ensures the collection. Okay, it says this is higher, so this will also be lower. It should be the lower receivable velocity should be there, because as much as quickly we should obtain the money. Here it will be the opposite. If it is higher, it will be lower. If it is lower, it will be higher. So velocity should be lower. Similarly, payable turnover ratio and how much time we pay. Okay, in a too much quickly payment is also not good. Too much delay payment is also not good, because if it is on a higher side, it indicates liquidity problem. Then profitability ratio based on sales. Now we come to the profitability ratios. It is very simple. Net profit, operating profit. It is very important ratio. Profit on investment. So investment means the capital employed. Please always remember, investment means capital employed, whatever be the source. Okay, whatever be the source of funds, whether it is a own fund or borrowed fund, we ultimately concerned with how much profit we have earned on the our investment. Okay, return on assets, average total asset. Okay, return on capital employed post tax, it is a pre-tax. Okay, return on equity is important. Okay, it is net profit after tax minus preference dividend, if any. It is net net worth or oblique, we can say it is not net worth oblique means net worth or the equity shareholder fund. Then earning per share is one of the important measure. Dividend per share and dividend payout is also very important, as this we have discussed in our sustainable growth rate or internal growth sustainable growth rate formula. 1 minus dividend payout is equal to retained ratio. Then price earning that we have discussed. Okay, or the value of business. It is help to calculate the value of business, and it is basically used to for the relative value and the stock market price. More used there. Dividend yield, very important ratio. Basically, change can be ignored because if we go by only dividend, but if we considering the same, then we can also consider it as a dividend if a capital appreciation. Then earning yield. Okay, one of the very important ratio where I need your attention, that is called DuPont ratio, and it is used to calculate the return on equity. So this ratio we referred in your paper AFM. Now there are, if we deconstruct or we can say that we dissimulate this ratio. So basically this ratio is a combination of three broad criteria. One is net profit margin. Okay, or we can say it combines the impact of three major forces. One is net profit margin. So it, of course, it is a profitability ratio. Then asset turnover ratio. So it is a measure of efficiency, operation. Then leverage. Leverage means financial solvency. Here the equity multiplier means the measures firms reliance on debt, that higher debt amplifies ROE but increase risk. Okay, of course, that is due to the financial leverage impact. If higher debt will be there, then of course the risk will be there. So when we multiply these three, okay, we get the return on equity. Okay, so what is the profit formula is here? Net profit divided by sales. Okay, this is the first formula. Asset turnover ratio means sales divided by assets, and equity multiplier, how many times the asset is of the equity portion. Okay, from this it cuts, it cuts, it cuts. So ultimately it becomes net profit divided by equity. So this is also one of the important criteria. So student, let us do one thing. We solve one numerical questions, and after that I will discuss the last topic. So, okay, the last topic will be the techniques used in company analysis. But before that, let us solve one questions. Okay, so assignment is available with you. Okay, student, I think the question is visible to you. No, it is not available in our website. Please confirm. Because last week I have got them uploaded. Please confirm whether it is available or not. On BS portal, yes. On BS portal, please. From where you have login in the system. Okay, if you check, still you don't get it, please mail it to me. Confirm it. Okay. If you can, okay, so that I can get it sorted out. Okay, student. Now the question is says like that. The following income statement and balance sheet partial pertains to the XYZ Limited for the financial year 2026. 1 second, I have to use the spec. Yes. Okay, the income statement is like this. 1 second. Let me use. Okay, the income statement like this. Okay. So this is the operating profit, EBIT. This is the less interest charges. Profit is there. Profit before tax, then tax is there. Then net profit, preference dividend. earning available for the equity shareholder, then less dividend paid, and this is the portion of retained earning. Okay, then partial balance sheet will come. This is our preference capital, this is our equity capital, total capital, share premium is there, profit and loss account there, balance is there, and ultimately this is shareholders fund. If we add their long-term funds there, so then it comes at 59 this. Now additional information is market price of the share is this much and no dividend has been proposed. So ultimately you are required to analyze the profitability from the perspective of the investor. So we have to analyze the profitability from the perspective of the investor. Okay, student. So let us start quickly solve the various ratios so that it becomes very clear. And it is a very simple question. Of course, only just for the sake of knowledge, I have included in your assignment. Otherwise, this type expected can be expected there, but just only for a you should be ready for any type of this small type of a question. Okay, so first of all, when we talk about the profitability analysis, so some ratios can be used. Okay, some ratios can be used. Okay, so what kind of a ratios can be used? So we can say that some ratios like this from investor point of view, very important from investor point of view. So I request you, please suggest me some ratios from your mind. Any ratios you suggest from investor, equity investor point of view. Any guess? Any ratios? Okay, now I start. Say if I'm an investor, one of the prime ratio which with I am concerned is with EPS, what I will get. Okay, of course I am concerned with the EPS, but please remember that whatever with the EPS, it is not completely distributed. Okay, it's only a part comes to me. So of course I will be interested in dividend. So I am maybe interested with the dividend per share. Okay, if of course some dividend will be come to me, then I have to see what is the dividend payout ratio, because it depends, dividend depends on the payout. Okay, now on the basis of earning per share, I can compute the earning yield ratio, that how much efficient the company is in earning. Similarly, I can compute dividend yield. Okay, then as a shareholder, I may be very important ratio. I am also related to the market. Okay, so these ratios are relating to the from the company's perspective. Okay, now there is one ratio that will connect me to the market, will be the price earning ratio. Okay, now once these two ratios are there, okay, so this is connecting me to the market, and in addition to that, I may be more interested in some other ratios like return on equity or return on shareholders fund. So these are some ratios. Okay, so these are generally say we can, it is indicates the overall profitability. Okay, and this is generally we can say that relating to the share specific in relation to the company, and this is part is relating to the market. Okay, so from investor point of view, we can say that we are can calculate this ratio. So now let us calculate one by one quickly these ratios. You note it down. Okay, assignment upload हो गया क्या? First, I calculate the earning per share. So this is profit after tax minus preference dividend upon number of shares. Okay, Ravinder is uploaded na? Okay, okay. So if I see here, what is my profit? This is 1 second. This is earning available to the equity shareholder 442 lakhs. Okay, number of shares. How much number of share is there? So this is our earning per share. This is the dividend amount available for the equity shareholder. Okay, dividend payout. Dividend per share divided by earning per share. If I am making a mistake, please correct me. Now it's also student. I think what I have told you. This is dividend yield. This is dividend yield and earning yield also relating to the this market. Please also connect it to the market because they are concerned with the market prices of the share. Then dividend yield. I am skipping multiplying 100. You can multiply in, or I do in one dividend per share divided by market price. See student, maybe I am using here abbreviations, but please in examination, please use proper market price dividend per share. Please don't use abbreviation in the examination. Because here because due to paucity of time, I may be using the same. Price earning ratio. Shareholders fund is. Okay. Now one last is return on shareholders fund. Here this 4 lakh is basically preference share. Okay, when we talk about the shareholders fund, so we add up profit after tax. Okay, and then we divide it by the capital employed. The figure comes 11.82%. So from our own perspective, we can give some valuation evaluation that will be common for that cannot be as common, that cannot be, we can say it is very, it can be subjective, so we cannot any generalize it. Okay, so with this we have solved one question. Now quickly I am just moving to the techniques used in the company analysis. Similar to it, these are correlation and regression analysis, trend analysis, and decision tree analysis. So decision tree analysis somewhat we have discussed in the advanced capital budgeting decisions. Okay, where the trees are there, trend analysis we can see from the past trend. Okay, so 1 second. Regression analysis is basically a line of best fit. Okay, here the time, here the variable. So we can see that whenever we dot a drawn arc there, so a line of best fit is used. Okay, so generally here it can be very like variation, standard deviation. So whenever, as we have discussed in the class of capital budgeting, so it indicates our sale is likely to be very, how much it is very likely to vary with time. So from where it can be analyzed that our with the as passage of time, the sale is going to be more volatile. So it is somewhat we can analyze the company's sale, etc., that it is likely to be very in a coming time. If it is somewhat flattened kind of a line. So we can say that the sale is likely to remain stable. Okay, so it is we can say regression analysis. Similarly, decision tree. Decision tree is generally, we can say that it is an option that if that is whether we have to market expand, then probabilities we attach to the probability and say if the market expand, our profit is likely to be 10 million. Okay, if it is further, it does not expand because it is first year. Okay, then there is, so what are the probabilities are there? First, it has expand, but then it has gone down. It is okay. Similarly, market contracts, then again, if it goes up, that will be our profit, and if it will be our loss. So accordingly, we can get the expected values of this joint probabilities, and we can get the expected values. So by these techniques, we can carry out the trend analysis I have discussed. Trend analysis, we can say that just generally we carry out some analysis what is on which trend is a company is going on, so we can do by the same. Okay students, so with this we have come to the end of this session. Now I request you to go through this portion thoroughly from the study material. So if you have still have any doubt, you can contact me over the telephone, or you can write us the email. And student, in the next class, we shall discuss the topic of technical analysis, and we will complete this topic, this topic of security analysis. So meanwhile, you have any please prepare the read the chapter, and whatever you doubts, please can we get this notes? Okay, I will see better. These notes are basically some copyright issue maybe there. So these are generally I prepared it from the study material. Okay, and you can do one thing. You can have you prepare your own notes. But if possible, then I will search out. If possible, then I will upload them. Okay, I will try. I will do something. I will try to upload them. Okay, student. Answer of the question. Okay, I will upload. No problem. Answer of the question I will upload. Not a problem. Okay, Ravinder, I will upload the answer of the questions in the form of notes. Okay. Okay, student. Any more question? Okay. Okay, student, thank you very much for your patient listening, and see you in the next class with the topic of technical analysis. Assignment is there. We shall complete the assignment there. Thank you very much and have a nice day. Thank you. Yes, session is